welcome back to another Random Gleanings. He is Chris, I'm Jesse, and after all the AI hype that we've seen recently, Chris, it turns out that there are other parts of the economy, and they aren't doing too shabby either.
Shocker. They're doing well, too. That's right. All right, so let's just review. And last week, the thing about last week, so we talked about cash, like on corporate balance sheets, right?
Yep.
And that sounds like snoozer, right? But I'm telling you, it's important because all that cash means driver of economics. And all the drivers of the economy ultimately lead to productivity, companies making more, et cetera. So all that's good stuff. So let's just kind of review where we are right now.
Yeah.
First off, first chart. All right, so the Atlanta Fed says, look, right now we're trailing at about a 3.2% growth rate, right? That's pretty good.
That's very strong for an economy of our size, and I think Q4 came in at 3.3, so we're just behind that, but that was a super high.
Yeah, I mean, 3% is good.
Yeah.
It's good. Okay. All right, so next chart, the National Federation of Independent Businesses, okay? Not everyone likes the notion of raising prices, but don't look down. I mean, there are companies that are raising prices. I mean this in a good way, okay?
Yeah.
I mean, corporations feel like, and these are smaller corporations, they feel like they've got enough power under their belt to basically raise prices if they need to, and enough corporate demand out there because consumers are in good shape.
They are, and some of that's in that cash story that we talked about last week while we were concentrated on business balance sheets. You know, there's been so much money that came into the economy over the last few years. It's still kind of settling out as to where that is. And to your point, small businesses are finding the ability to raise prices into it.
I remember a couple years ago talking about there's $3 trillion in cash sitting out there on balance sheets, okay, both individual families as well as corporations. But that was at earning 0 to like 1% interest rates. Now there's $6 trillion earning 5.4% interest.
Yeah.
That's a big deal.
Yeah.
It's a ton of cash. Okay, next chart. Let's talk the election for a minute. So, we always hear within our other, it's an election year. The reality is if you go back over the last, since post-World War II, there's the batting average for a positive year for an election year, regardless of whether it's Democrats, Republicans, et cetera. I mean, the batting average is 890 for a positive year. Mm-hmm. That's pretty darn good.
Yep.
And when a Democrat incumbent is running, it's actually better, right?
Yep.
And that's not advocating for one or the other. It's just saying, hey, when a Democratic incumbent is running, the numbers are better.
Yeah, I think this is one of those, noise and signal, right?
Yeah,
because the noise gets really awfully loud during an election year. But if we can but use history as a guide, these years are not negative. They just aren't. So.
Next chart. This is the election cycle. This is every election year from 1950 to 2020 in the chart. Kind of similar. And then this is the actual in red for the S&P thus far. So you can see, the level, we've gone up pretty quickly out of the gate relative to the first few months normally being sort of a little calmer.
Yeah, so this is isolating the fourth year of that 4-year cycle. And to your point, it looks like it's been a hot run here, which we've experienced.
Hey,
for sure.
but look, you can see the note right there from our friends at All Star Charts. Trend is more important than level, and the trend has been up, which is good. All right, so with all that as a backdrop, here's the thing, okay? Mm-hmm. If you consider the fact that, the Magnificent Seven and the NASDAQ and,
technology.
Technology,
right.
Nvidia, all those names have been like the hot things. Here are a couple examples in the last 6 months that are doing pretty darn well themselves. Number one, Cintas Corporation.
Okay.
Sexy. Very sexy.
Uniforms. I feel like they used to come in and replace a rug or something.
Yeah, they'd come in and replace your rug for like wiping your feet.
Yeah.
Or your uniform if you were gonna,
If you're a business that has a uniform, they supply those, and I think that they can even come and grab them and wash them.
So Cintas is in the industrials sector, right? The most diversified sector of the S&P 500. I'll show you a chart of that in a second. And then let's look at some other ones.
But it's been beating the Qs over the last 6 months, with Qs, vernacular for the NASDAQ 100, which is highly concentrated in those Mag 7 names.
So next one up the chart is Elf Beauty. And I don't know a whole heck of a lot about Elf Beauty. I don't know if you do, but
I know there was a period there that my wife used to like to buy Elf nail polish. So I don't know anything beyond that, but I think they're a brand at Target and probably elsewhere. And so yeah, I mean, it's odd to see something like that do so well.
It's a consumer discretionary item, and people have money. Look at Abercrombie and Fitch, which is up about double that of Nvidia during that same 6-month time period.
I mean, it's bananas. It really is. I don't understand that, and this is not an advocation that you go out and buy any of these names by any means. Some of that's market cap related. Some of it feels a little meme stocky back, but at the same time, they've got some earnings to support some of this growth coming off of a rough patch as a business.
Right.
And so it is, I think, to your broader point, there are other things that are working besides Nvidia, the purple line there, that is getting sucking all the oxygen out of the media storms.
Right. So let's look at industrials real quick. So this is this is the top, well, it's not quite 25 holdings, but it's some of the top holdings from the industrial sector, okay? So GE is the largest at 4.5%. By the way, I mean, you go into consumer discretionary, like Tesla and Amazon have been 20% of that sector ETF. So this is a more diversified sector. Now, I mean, you've still got some 4% type holdings, but at the end of the day, it is more diversified. So look at this chart. This is a chart of U.S. manufacturing and services Purchasing Managers Index, okay? So U.S. manufacturing's what? 15-20% of the U.S. economy. Yep. Services is the other 80-85% in that neck of the woods. And what you can see is in the purple, manufacturing cratered back during COVID, got better, has been sort of languishing, but you kind of wonder if there's a little bit of a troughing going on, a bottoming in PMI. And same thing in services. Services since the beginning of the year have been kind of starting to tick up a little bit as well. So if that's the case, you look at what industrial stocks did back during COVID, and obviously they got hammered, but they did start to recover as PMI started to recover as well. So the question is if we're bottoming, could there be some names in there that might be attractive,
or just the the kind of the sector as a whole? I mean, and the pattern seems to be aligned such that if PMI continues to expand and we get back into an expansionary area, then it's certainly not a negative for those stocks in that sector or for the overall stock market and the economy.
So 3-4 weeks ago, we talked about small caps a bit and how small caps relative to the S&P were still substantially off their highs, had not made new highs. I think at the time they were down 20% off their highs. I don't think they've made necessarily substantial ground between then and now. But I mean, so here's the S&P small cap. So do you know the interesting difference between the S&P small cap and the Russell 2000?
I mean, it's one is a smaller index, 600 versus 2,000 companies. But,
right.
But the big deal is that S&P 600 has, those companies all have positive earnings.
Right. So the S&P 600, to be in there, you have to have actual profits.
Right.
Whereas the Russell 2000, you do not. So take a look at this chart, which is same thing, manufacturing and services PMI and small caps as well. So the big question is yet again, are we kind of seeing somewhat of a bottoming process here? And again, look, this is not an advocation of go buy industrials, go buy small caps. Do your own research. But certainly, I mean, if we're going to see a broadening out and other stuff besides tech work, I mean, surely you want to start looking in places that are a little less expensive.
I mean, that's the big takeaway, I think, is that, we've made a case that maybe some of those big tech names at least look highly valued. Does not mean, and they already gotten more richly valued. But if you have money to deploy and you're looking for value, there does seem to be areas of the market that have a better value than those big names.
Right. Yeah. So really that's it. Don't take this as advice. Just take it as, hey, begin to look around. I mean, if things are good, got to look around and see what might add some value other than just technology.
Yeah,
right.
For sure.
All right. You watching anything good?
We've been into a documentary about John DuPont. I think Foxcatcher or something. It's really interesting. I'll maybe follow up if it closes out strong. But definitely.
Whenever we're between shows, that 4 6s looked. It sounds interesting to me. Sort of another Yellowstone spinoff. I don't know when that's coming out, but that's something I look forward to. Other than that, we binge watched Suits trying to get through, and we're about halfway through season 5 of 8. So anyway,
Prince Harry showed up yet?
No, and Meghan Markle's still around too. Okay. So I keep waiting for her to drop off any day and for her to go be a royal, sort of. All right, friends, as always, thanks so much for watching. We're grateful to you. Please do click subscribe, and feel free to share this as well. Ding the bell to be notified when we post. Thanks so much.